Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can understand what we see in the global landscape. You know, we continue to see improvements in the U.S. economy, and one of the things I want to talk about is the holiday season and shopping. One of the old metrics to kind of gauge how things were going in the U.S. economy, especially towards that, the last part of the year, is really retail sales. Well, today retail sales are much different. I'll give you an example. People are not shopping in stores near as much as they used to. So when you hear retail sales numbers from a traditional Walmart or Target, a lot of these numbers actually are not that great because people are shifting to online. Online again this year is expected to grow another 15 to 20% on online sales. Every year we're seeing bigger and bigger increases. Most of my buying this year for Christmas has been done online. In fact, I doubt I will even go into an actual store to do any of my holiday shopping. Bottom line is this. Retail is shifting away from brick and mortar and it's going to online. Things like Amazon and companies who have good internet presence with their retail side. So don't be worried about retail sales maybe being lackluster or down because the real kicker is online. And as long as we're seeing significant increases, it shows the consumer is out there and they're healthy. Unemployment continues to improve. Initial claims, housing continues to improve. These are big drivers of the U.S. economy. Remember, the consumer is 70% of the U.S. economy. The service sector is roughly 70 to 80% of the U.S. economy, and those are all doing well. Manufacturing is a little bit light, but again, it's a smaller percentage versus the service sector that contributes to our gross domestic product or GDP. We believe we're going to have decent earnings for the fourth quarter, but what we're starting to see is revised earning revisions up as we get into 2016. This year so far, the markets are kind of flat to down a little bit. We've seen not a lot of activity other than this volatility. I always try to educate our investors, expect it. This could be the year you're down 2% or you're up 2%. That's it. Next year could be potentially one of those gangbuster years. We're up another 18 to 25%. We've seen it happen before, and I firmly believe we may be setting ourselves up for a much better 2016 because we've had this subdued 2015. Earnings again are increasing. Earnings drive equity-based prices. We're starting to see a slow rise in interest rates, very slow, methodical. We've actually raised some cash on our bond side to protect against losses from bonds. We're going to put that to work when we see fit. But at the end of the day, the U.S. economy is stable. We're primarily in the U.S. economy and the markets. We are out of all other countries basically outside the U.S. because they've been relatively weaker. We want to stay in relative strength. We anticipate a year-end rally as we go through the end of December. But I ultimately believe if things stay on the path we're on, 2016 could be a very, very good year. Remember, every year is not up. If we end up flat for the year, I'll actually be happy with all the volatility we've seen, but I think we set ourselves up very well for 2016. If you're a client of our firm, please give me a call if you have any questions. If you're not a client, it's time you became a client, or refer your friends, family members, and business associates. We always appreciate all of your business. Make sure you have yourself a safe and profitable day.